So, you want to be a real estate investor, but where do you start? How do you know what information and sources to trust? That's where I come in. I'm Jonny Cattani, and this is the Investor Relations Real Estate Podcast. Hey guys, real quick, before we start, go to investwithcattani.com and download my free ebook, Is Commercial Real Estate Recession Proof? Now to today's show. What's up, guys, and welcome to another episode of the Investor Relations Real Estate Podcast. I'm your host, Jonny Cattani, and today I'm joined by Anthony Chara. Anthony is a seasoned real estate investor that has investing and property management experience dating back to 1993. Mr. Chara turned to apartments full-time in 2004 and has owned or syndicated over 2,000 apartment units around the country. Presently, he's managing partner of Apartment Mentors and founder of Success Classes. During the past 20 years, he has owned or managed several successful companies. Mr. Chara started his teaching career in September 2006 in order to educate both the beginning investor and more sophisticated investors about how to successfully invest in apartments and multi-units. Mr. Chara also volunteers and supports several worthy charities, such as the American Red Cross, Denver Rescue Mission, Habitat for Humanity, St. Jude Children's Hospital, and Wounded Warrior Project. Anthony, thanks so much for coming on.
Hey, thanks for having me, Jonathan.
Absolutely. We were kind of talking a little bit off camera here. Obviously, you have a very incredible resume and great story, but let's kind of start at the beginning. What led you back to this space, all the way back in the early 90s?
Sure. Well, I, like a lot of people, had a regular corporate job. I was working probably 70, 80 hours a week, working for somebody else. And one of the other things that kind of happened during the course of that employment was I developed claustrophobia while on a plane flight. And the final straw for me back in the late 90s, about 1996, 1997, is our company decided to do a reorganization. They got rid of a couple managers, but I was not one of them. They told me I was one of the lucky ones that got to keep my job. And because of the claustrophobia, I had a hard time getting on airplanes. I pretty much felt nauseated from the entire time that I got on until I got off, because I felt trapped the whole time. So I was looking for an alternative, and the final straw was when the company did reorganize. All of a sudden I was going to be back on a plane again. So instead of being able to drive my territory, because I live here in Denver, and I had from Cheyenne, which is north of Denver, all the way down through El Paso, which is directly south, I could drive that in about 2 hours up to Cheyenne and 6 to 12 hours down, all the way down to El Paso through Albuquerque. And now that I'm getting back on a plane again, it's like, my psyche basically just shut down and said, I really don't want to do all this travel and get on planes again, because it was just too stressful. So I talked to my wife, and she basically backed me that it was literally, my job was literally killing me. So I quit and started getting into other things. We opened up a couple small businesses. Matter of fact, a lot of you know about Uber Eats and Grubhub and things like that. Well, we started a company up called Dine-In Delivery. Well, we didn't start it. It's actually a business opportunity. Then we learned how to do that and started that up in Denver and grew it 40% year over year. But I realized that it was just, again, it was killing me because I was too busy working in the job instead of on the business, right? I was doing driving and dispatching and all kinds of stuff. And so was my wife. So we decided to sell that. And we had actually gotten into real estate investing kind of through the back door in 1993. Just because we didn't sell our first home. We moved out of our first home, turned it into a rental property. And then that's really all we knew, is to do buy and hold residential real estate. So we did that for about 10 years. And then in 2000, when this other job was literally driving me nuts again, because I was too busy working in it instead of on it, we decided to make another change. So we sold that business and kind of got into note investing. Well, then the note investing didn't really pan out, didn't really go anywhere. But during one of these conferences, met Robert Allen and became one of his proteges. That was his protege program way back in the early 2000s. Paid him a lot of money, learned how to do real estate, because we didn't know about fixing and flipping. We didn't know about wholesaling. We didn't know about short sales. We didn't know about any of that stuff. All we knew was buy and hold. learned a whole bunch of other strategies, got into apartment investing, met another partner, a gentleman named George out in California. We started buying apartment buildings around the country. And at the same time, we realized that there was a lot of stuff that other people's, other instructors, other gurus were teaching that left out a lot of the stuff that we learned the hard way. So on top of that, not only were we doing the apartment investing, but we also decided that we were going to start teaching other people how to do some of this stuff because we didn't have anybody showing us how to do it to that point. So it went from single family home investing in 93 to about 2003, 2004. That morphed into apartment investing. And as you mentioned earlier, we've owned over 2,000 units throughout that 15-year period. And that, of course, also translated into what I'm doing now, besides the apartment investing and some other commercial investing. I just started to teach classes to show other people how to invest in properties successfully.
Awesome. I love that. That's a great story. And kind of, you know, most people initially get introduced in the residential side, but, you know, kind of that scalability comes into play pretty quickly if you really are trying to progress and make it a full-time job, which you ran into. So you recognized early that there were not a lot of good quality teaching then. So it sounds like you were still pretty new when you recognized the opportunity to also teach.
Yes, yeah, we were fairly new to it. We'd been doing it about 2 years before we started up our classes. But what we realized is that at that point, we only found one other person out there that was actually teaching this stuff. Now I'd have a mentor here in Denver named Ron, who was teaching me some of this stuff too, but there was only one, as you say, guru that was actually teaching it back then. And so at some point after we had bought some property, we went to his course, but we realized that while we were in his course, it was really about selling the next course and not really necessarily teaching you how to do it from a nuts and bolts perspective either. And at that point, we'd already started to teach our classes and just felt that we had superior classes to begin with and just expanded from there. So we started our first class in 2006, and here it is, 16 years later, and we're still doing it and love teaching it.
That's awesome. I love that. And that's what I love about the industry now. Sounds like it was a little different back then, but everyone's willing to just share their secrets, so to speak. There's not really many secrets left in the industry, but everyone's willing to give that. And that's what I really love about this industry is people like yourselves are like, hey, look, I've been successful and now let me show you how to do it. So you kind of jumped into it right in 2006, right before our, you know, the big financial crisis. So kind of talk about what that looked like, you know, first from a real estate perspective and then kind of a teaching perspective.
Sure. Well, there's actually two sides to, as they say, every coin. Actually, if you listen to Robert Kiyosaki, there's three sides to every coin, right? You've got the heads, the tails, and then the edge. Well, when it came to real estate, there was the heads and the tails for us. And the residential side, the single family home side, we actually started struggling with between my wife and I, because back then we had roughly 9 or 10 single family homes and condos spread out between Nevada, Arizona, Colorado, Florida. And at the same time, we also had some loans that were adjustable rate loans. So we ran into a very interesting situation that a lot of other people also ran into, because interest rates were going up, rental rates were going down, and values of properties were going down because of all the foreclosures that were happening between 2006 and 2009. And so all of a sudden, we were in a very precarious situation because of our single family homes. We literally went from a couple $1,000s a month in negative cash flow, which wasn't a problem when we first got into it, because my wife still had her great job. She was making a ton of money as a director for a healthcare organization here in Colorado. And I was out doing real estate investing on my own basically by then, and hadn't started the classes yet. And of course, we were having a little bit of a struggle with that. And we literally, our savings account started to get sucked down to nothing, because we went from maybe $1,000 to $2,000 of negative cash flow each month, which was survivable for us because we had a very big savings account. Sue had a great job. And then all of a sudden, when the interest rates went up, rental rates went down, all of a sudden when the interest rates went up, our mortgage payments went up tremendously. So we went from $1,000 or $2,000 a month in negative cash flow to $10,000 a month in negative cash flow. in just our single family homes. So fortunately, we had our apartment complexes working for us because that helped us survive that downturn, which we wouldn't have been able to do if all we had were single family homes. So the two sides of the coin are this: it was the single family homes were basically about to ruin us. And we had actually talked at one point to a bankruptcy attorney just to see what our options were. But fortunately, on the other side, the apartments were doing great because some of the people that were being foreclosed were doing what? They were moving out of their single family homes and moving back into apartments. Plus, some of the areas in the country where we had our properties, they were actually doing very well. One of the properties was in Shreveport, and they had just discovered one of the largest natural gas finds in US history underneath Shreveport. So that particular property was doing well because oil companies were hiring like crazy. And so we were able to survive through 2006 and 2008 and 2009 because of the apartments that we had. We didn't actually hit a downturn in the apartments until 2010, 2011, which is when the housing market took off again. And there was a combination of things that happened with people moving out of the apartment complexes. We also had a couple complexes with poor management, and I couldn't get my partner to unfortunately replace the manager from some of the things that I was seeing. He was very stubborn and stuck with this person and very loyal. And we actually ended up losing one of our properties because the manager wasn't doing what she should have done. And she had a very flippant attitude when it came to the C-class investors that we had in the property. She basically just kind of threw up her hands and said, well, that's what you get with C-class properties, is people that don't care if they pay and they don't care if they take care of the property. So we've seen some highs and lows. So fortunately, with the balanced portfolio, when the housing, single family homes were going down, the apartments were going up. And then it kind of reversed when the apartments started going down in 2010, 2011, 2012, single family homes started going back up and our rental rates went up, our mortgage rates went down. And again, we were able to survive that whole situation. And now we're thriving.
That's quite the roller coaster ride that you guys went through. So obviously that allows you now to even be that much better of a mentor and a teacher because you've been through the highs and lows on both sides. So let's kind of stick with the apartment side of things. Obviously had, some poor management. What are kind of some of the lessons you learned from that deal moving forward, and that you teach?
Yeah, there were a couple things that I would say we learned throughout this whole process, and we're still learning. No one should ever assume that just because you've been doing this for 10, 20 years, that there isn't more to learn. There's always more to learn. So, but the main things that we learned through the process was a property manager can make you or break you very, very quickly. And so one of the things that we've started to do is actually find multiple property managers in a location first before we start purchasing properties in a particular market. And the reason we want to find multiple property managers is because one of the lessons we've learned, other than this one property, we've had other properties around the country where we've had poor management, but those managers didn't start out poor. They answered all the questions the right way. All the things that you want them to do as far as how they're going to take care of the property, how they're going to fill up the property and market it to residents and take care of repairs and all those things and take care of the upkeep. They answered them all correctly. The problem is once we then hired them and gave them the keys, they didn't follow anything that they told us. We had one property outside of Philadelphia where they weren't filling up the units. It was a 31 unit property. We had one vacancy when we bought it. 2 or 3 months later, we had 9 vacancies.
Jeez.
And we're asking them what's going on. Well, it's kind of in a marginal area and just a couple blocks over, it's kind of rough. Okay, that's a couple blocks over. So why aren't you filling up our unit? Well, it's just kind of not the greatest area. They weren't really telling us why they weren't filling it up. They were just telling us why it was a bad area. It's like, if this was that bad of an area, why didn't you tell us this before we bought the property? Right before we bought it, it was, oh, this is great. We'll fill it up. No problem. You can raise the rent. That was the other reason we bought it. They told us we could raise the rent from $700 a month to $850 within the next 2 years because that was what the market rate was. Well, so we made the decision. We hired them and then found out that that wasn't the case. They basically told us what we wanted to hear to get the job. Well, we didn't have a backup manager. So this is one of the other lessons we learned, right? You want to make sure there's more than one management company in the area that you think is qualified and answers the questions correctly because you may need to make a change. So we changed them, went to somebody else. They filled it up, but at the same time they were filling it up, they were spending way more money than was coming in. And we tried to get them under control, and they wouldn't get under control. Matter of fact, they specifically had guidelines in their contract that said they were only allowed to spend $3,500 a month on expenses, on all the expenses. They spent $4,000 on one rehab.
Oh.
And that one rehab was only 550 units, and it was ridiculous. All they did was put in carpet and painted it, and they charged us $4,000, which was ridiculous. So we replaced them, right? Then we had to go out and find a third company. So we've had 3 different projects where we've had to replace the property manager 3 times, or technically, I guess, replace them twice and have 3 total managers. Most of our properties, though, run very smoothly. Most of them, the same manager that we hire when we are that's on board when we buy the property is there later on. So the main thing, one of the main things we learned was to have at least 3 good management companies in the area. So in case the one talks the talk but can't walk the walk, you can get rid of them and bring in somebody else. The second thing that we learned through this process is verifying the demographics of the actual neighborhood, both from a crime standpoint and an income standpoint, because you want to make sure people that are in your area, the area where you're going to buy these properties, have enough money to actually pay the rent on a regular basis, on time, every single month. So between the crime and the level of income and schools ratings and things like that, we want to verify what's going on in the market. So those are some of the things that we learned during our down cycle. It may not have been everybody's down cycle, but our down cycle on our apartments. So we do much more in-depth due diligence on the market and the property managers before we actually start buying properties in an area.
Makes perfect sense. And this is something that I don't think enough people talk about, is kind of vetting your property managers and making sure you have a good one in place. And obviously, once you're established with a good one and you continue to invest in that market, you know, they kind of just continue to take over and it runs seamlessly. So kind of talk about now your due diligence process for vetting these property managers and how you kind of get through the, you know, the honeymoon phase where they tell you what you want to hear and actually, you know, be able to make sure they're going to do what they say.
Well, so we have probably 50 to 60 questions that we go through with the managers. And obviously it's not perfect, because some of the managers that answer all the questions correctly with how they're going to handle things, how they handle evictions, how they're going to do their marketing, how they retain their residents. So you've probably heard this before too. And it not only works with business, but it works with property managers. If you're a business owner, they tell you it costs you less to keep a customer than to go out and find a new one. Well, it's the same thing with residents. It costs you less to keep a good resident than to go out and find another good resident. So we ask all kinds of questions about how they take care of their processes on a regular basis, what kind of systems they have in place in order to do the maintenance, to find and vet new residents, to make sure that the residents are going to come in, they're going to take care of the property, they're going to pay on time, they're going to get along with their neighbors. So all the questions we ask are the same questions of every property management company. So we don't necessarily have a crystal ball on that aspect, because as I mentioned, we've had some that answered all the questions the right way, but then when you give them the keys, they don't perform, right? They talk the talk, but they can't walk the walk. So we haven't been able to perfect that part of it yet, but what we have done is we don't sit around waiting for them to fix it. We have a conversation with them to let them know what the problem is. If they're not willing to fix it, or they don't show that they're fixing it, then we just get rid of them. And, you know, I know some of your listeners, Jonathan, are going to be saying, well, wait a second, you've got a contract. You can't just get rid of a manager. Well, yeah, you can, because the contract says you can get rid of them for cause. And so I jokingly tell my students, I'm getting rid of you because I want to. But most of the time it's because they realize it's not working. We're upset. We're calling them on a daily basis if things aren't going well, asking them what they're doing. We drive them nuts. They're driving us nuts. So we usually get a mutual parting of the ways long before the current contract is over, because we both know it's not working.
And are these, you know, are there various aspects of this? Sounds like part of it is, you know, not hiring the right vendors to get things done, and, you know, potentially not screening residents correctly. Is it kind of like all of that together?
It's not necessarily the vendors that we found that the property manager is not doing the right job getting the vendors. I think it's just the property manager themselves. it's kind of like a job interview. Well, it is a job interview. They want the job, they say the right things, but then they don't perform. They don't do what they're supposed to do. In one case, as I mentioned, the one manager that spent $4,000 to rehab a 550 square foot single one room, one bedroom.
Was there gold in the paint? Is that what happened? They used gold paint?
Yeah, gold plate, gold flooring, yeah, gold appliances. Yeah, you got it. It was ridiculous. And especially when they have a contract. And that was the cause that we were able to fire them, is like, you have a contract that says you're not allowed to spend more than $3,500 on all of the expenses per month without written permission. And they're like, well, it needed to be done. It's like, that doesn't matter. You broke the contract. You violated the contract. You're fired. So they weren't too happy about it, but we had another conversation with them. Before they spent the money, we were trying to get them to help. I was working with one of my students who was the main person doing the deal. And I said, we need to get them involved. They need to help you create a budget. So we had a three-way conversation with the manager, and we said, we need you to help us create a budget for this property so we can stay on track. This is a business. That's what a lot of people don't get. You're not, when you buy an apartment, people think you're buying real estate, which it is, but it isn't. It's a business that needs to be operated as a business. And part of any business, you need to have a budget. And you may not hit all your numbers the way that you need to hit them every month, month in and month out, or year in and year out, but at least you have a guideline. It's like, imagine getting in your car in Denver and deciding you're going to drive to Orlando. Well, what are you going to do, right? You're going to get a map, right? You're at least going to know where you're going. Now, that doesn't mean that you're going to hit a roadblock, because maybe there's construction and you have to take a detour, right? But at least you have that path that you're going to be going down. And so you need that path, which is your budget, to make sure that you have some goals in place. And literally his response was, budget? Well, there's no budget. You own the property. We manage it. We tell you how much money we need to take care of it, and you send us the money. That's literally what he said. And so as soon as we got off the phone, I called the student right back and I said, time to start finding our third manager, because this guy ain't going to make it. And unfortunately, we didn't find a replacement before he spent the $4,000 to fix up the one unit. So the big thing you need to have is, right, you need to have that guidance. You need to have the budget in place. So it's not really the vendors, right? They are responsible for hiring the vendors and doing that kind of stuff. But he should have known better. He had a budget. He had a roadmap to follow, and he just decided he wasn't going to follow it at all. He just went off course.
God, it's so fascinating to even think that, because ultimately, right, like their success is yours. Like, it's a symbiotic relationship. So the logic tells you that they want to do the best they can to keep you as a client, especially if you're going to stay in that market and continue to invest there and hire them to keep managing more properties. So that is fascinating that you've run into this so many times. So, we've talked about, obviously, when you go into an area, what your kind of process is starting out. A property management's obviously a huge thing. You like to have at least 2 or 3 in place. What are some of the other steps in your kind of due diligence in terms of the market, and then ultimately due diligence on an asset?
Sure. So a couple of the other things very quickly that we go through is we want to make sure that the median household income in a particular neighborhood is at least $45,000 per year. We want to make sure that the median rent is at least $750 per month or more. And, it's kind of one of those interesting things. When I first started out, when it came to rent and the value of an apartment complex, obviously, if an apartment complex is only charging $400 a month for a 1-bedroom unit, there's a lot of people that can afford $400 a month. But you go a couple miles away and now you've got one where 1 bedroom is $800 a month, and you're thinking, wow, that's a lot more expensive, which it is. Right? It's twice as much. There's not as many people that can afford $800 as $400. And of course, the price point, right? It's twice as much for the one that's $800 a month as it is for the one that's $400 a month. So when we first started out in the mid 2000s, we're thinking, okay, lower rent, more potential renters, lower price point to get in. So we started buying up all these low-end properties. And what we found out the hard way, because we didn't have that person that was teaching us what to do and what to look for, we realized the hard way that when people are only making $400, or the rent is only $400 a month, Well, let me rephrase that. Let's look at it this way. Our minimum income requirement is 3 times rent. So in order to get into a $400 a month unit, that means that somebody has to only make $1,200 a month. So they make $1,200 a month before taxes, and then they pay $400 a month for rent. So that leaves $800 left over. Excuse me. So we weren't really looking at it that way when we first started up. We were just thinking more people can afford 400. Well, then you start looking at it logically and say, okay, now there's an $800 unit. Well, in order to qualify to get into an $800 per month unit, they have to make $2,400, right? 800 times 3, right? 2,400. So if they pay the $800 in rent, now they've got what, 1,200 left over, or no, 1,600 left over, right? $1,600 left over. So they've got 1,600 left over as opposed to the other family that only has 800. So out of the 800, right, they have to do their car and gas and food and groceries and utilities, where the other family who's paying the same amount for electricity, the same amount for groceries, and the same amount for gasoline, right? All their expenses are the same. The only potential difference is their cars. Do they own a car? Do they rent a car? Do they have a car?
Right.
There's a lot more money, right? $1,600 goes a lot further than 800. So what we've learned from there is to start buying properties that actually have higher rental rates, because it's going to take more income for that person to qualify. And that's why we look in those particular areas where the median income is at least $45,000. The median rent is at least $750 per unit, and the higher the better. We also want to check the crime in the area. Now, you're not going to have any crime-free areas at all, but we want to invest in areas that have low violent crime. So things like shootings, gun activity, rapes, murders, that kind of stuff. And then the last thing we look for, the main other thing that we look for, is school ratings. So there's a website out there called greatschools.org, or you can go through, it's either Zillow or Trulia. One nice part about going through those, and I think it might be Trulia, actually takes you directly to the greatschools.org website, but it also only shows you the schools that are for that particular property. So in other words, the elementary school, middle school, or junior high school and high school, it shows you the ones just for that property. If you go to greatschools.org, it just shows you all the schools.
Right.
So if we go in and look at the school ratings, we want to see school ratings of 5 or higher, because 5 or higher generally means, from what we found, the higher the school ratings, the lower the violent crime. The lower the school ratings, generally the higher the violent crime.
Okay, that makes perfect sense. And that's a really solid foundation to build on, because the rest you can kind of just plug and play. You know, if it's a heavy lift, you're willing to do it because obviously, you know, the other metrics meet your qualifications and different things like that. So it really allows, you know, like I said, that solid foundation. And so this obviously you take into every market. So do you look for a certain, like, do you only do multifamily, or do you guys venture out into other asset classes?
Yeah, great question. So we did, we'll still do multifamily. Matter of fact, I teach classes and other people on how to buy multifamily. But when things started to slow down, probably about 2-3 years ago, we started looking for other alternative investments, because we wanted to keep money coming in. We wanted to keep the cash flow coming in. We wanted to continue to find things for our investors. And so what we found was, especially with something called bonus depreciation that was happening, where you can actually take a lot of those things that you normally depreciate off over 3, 5, 7, 15 years, and you can shorten that and take it all in the first year. There were a lot more people that were now going out and buying properties to take advantage of that, because you could literally, on a $2 million property, put down $500,000 for a down payment and get most of that back at either tax deferment, tax credits, some type of a credit going forward. Sometimes people could use that all in the very first year, or they could use it over a series of years. But there's a lot of high net worth people that were buying properties just for the bonus depreciation advantage. Then people started seeing what was going on with the government printing money because of COVID, and just sending out all these stimulus checks. And they realized that inflation was right around the corner. So because of inflation, one of the things you want to do is you want to own real assets like real estate. So a lot of people then started to buy more real estate because of the inflation that they saw coming, which is now here. And prices just started going through the roof. Properties that used to sell for $50,000 a door 4 years ago are now going for $150,000 a door. Properties that were going for $100,000 a door are now going for almost $400,000 a door. It's nuts. So deals are still out there, but we wanted to look for other alternatives. And also it helped with the diversification. So one of the things that we did is we started investing in foreign government, or not foreign governments, but foreign territories. So we actually bought part of a hotel down in the country of Belize with our investors. Matter of fact, we just raised $4 million just a couple of months ago to add an additional 34 units to our portfolio down there.
Wow.
So we now own 43 units at this hotel down in Belize called Mahogany Bay Resort. And so we own about 10% of the hotel. About 2 years ago, actually, no, actually it was 3 years ago, right before COVID hit, we heard about an investment down in the country of Paraguay, and it was an agricultural investment. So it had to do with greenhouses, orange grove lots, and hydroponic greenhouses. So two different, so regular greenhouse and a hydroponic greenhouse, which are a little bit different. And so we went down, my wife and I flew down to Paraguay and looked at the investment, met the people that were running the investment, and basically the farm or plantation because of all the orange trees and the greenhouses. And we decided that this looked like it was going to be a good model for investors with some really good cash flow returns. We're over it's a 10-year term, and we're looking to average around 20% return year over year for that 10-year period. So we decided to buy a bunch of their properties that were down there. We ended up raising $1.1 million in order to get our investors into some other cash flowing alternatives besides apartments. So there's all kinds of things that you can get into to get great cash flow.
Absolutely. And I imagine $1 million goes a pretty long way down there in some of those South American countries. So I can imagine that was pretty solid acquisition. And, you know, kind of, as my listeners will see, and a lot of my guests mentioned, it's not, you know, obviously we talk mostly about commercial real estate, but if you notice, the most successful people invest in multiple assets, right? You want to diversify, you know, not just commercial real estate asset classes, but, you know, all the way to agriculture and some of these different opportunities that you have, because, you know, we've obviously all, you know, a lot of us remember what happened in 2008. We, you know, want to avoid that, but also, you know, there's different tax incentives for some of these other alternative assets as well.
Yes, there is. Yeah, bonus depreciation works with those in the same token. So we have our bonus depreciation on the hotel, bonus depreciation on the equipment that we're buying, the greenhouse itself down in Paraguay.
That's awesome.
So even though it's a foreign asset, we can still pass that depreciation on to our investors.
Wow, that's awesome. And again, you know, we talk about this in a few episodes, but the IRS makes it very simple. There's like, what, 3 or 4 things you can't depreciate. Other than that, you know, you get that bonus depreciation, and it's a huge, huge incentive. So awesome. This has been an incredible story. We're right up against time here. So I have 5 questions that I ask all of my guests. It's the final 5 questions. So we'll get to those. So the first one is, what's the best advice you've gotten from a mentor?
Probably the best advice I've gotten is to always keep learning. Don't just assume that everything is done and you know it all. Keep learning. So, matter of fact, I just joined somebody else's mentorship program because I want to keep learning. There's always something that you can do better, faster, differently, and don't just get stuck in a box and keep doing things the same way over and over again.
That's the truth. What is it about your career that makes you feel like you're fulfilling your why?
I think that's probably all the people that I've helped, all the successful people that have gone out and then taken what I've taught them and gone out and bought apartment buildings or other types of commercial property. It's not just apartments. I've had students that have purchased RV parks, mobile home parks, storage facilities. So there's all kinds of things that you can go out and do. So that's helping me fulfill my why, is by basically educating other people on how to be successful and not have to worry about working for somebody else for the rest of their lives.
Gosh, I love that so much. What's your favorite non-real estate or investment related book?
Non-real estate or investment related. Probably, I'm a big sci-fi nut. So I like a lot of the sci-fi books, like from Isaac Asimov. I love Dune, right? The movie that just came out, the The second movie, actually, there was a movie that came out probably 30 years ago that was absolutely horrible, but the books are phenomenal. So I like sci-fi.
Yeah, most people don't talk about the first one because it was that bad, but there was an original. So if you could have any superpower, what would it be?
The superpower, probably just, to be bulletproof. So you didn't have any of that fear of some of the things that are going on in our world today.
Yeah, that's the truth. That's a good one. Awesome. And last one, what's the best way for people to get a hold of you and learn more?
Best way to get a hold of me, you can go to my two different ways. You can go to my website, which is successclasses.com. You can also email me, Anthony@successclasses.com, Anthony@successclasses.com.
Awesome. We will link that in the show notes. Anthony, thank you so much. This has been awesome.
Excellent. Thanks for having me, Jonathan. I enjoyed it.
Absolutely. Hey guys, thank you so much for watching today's episode. I hope you really enjoyed it. Listen, I know it's cliche and you hear it all the time, but please don't forget to like and subscribe to the channel so you know when the next video is coming out. Even though this is technically a daily podcast, you know it's coming out the next day. We have a ton of content coming your way. So please like and subscribe. It helps a ton. Leave comments. Would love to know what you guys think. And we will see you on the next one. Thanks so much.